Welcome to another bar walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over bar area 1. This is section B4. This is an application topic. Use strategies to mitigate financial risks, such as market risk, interest rate risk, currency risk, and liquidity risk. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam. And again, it's free, so make sure you check that out because we will save you months and months of struggling with the exams. After you watch that, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. Pro members get access to the full versions of these videos. So in today's video, we're only going over 5 questions, but SuperfastCPA Pro members will get access to the full 10-question version of the video in the member forum. So if you like this and you like our other videos, make sure you check out becoming a Pro member because you'll get access to the full versions of these videos. Now with all that, let's dive straight into the questions. Alright, here we are at question 1. Let's just dive straight in. Which of the following strategies would best mitigate the market risk faced by a company with a large portfolio of publicly traded equity securities? Okay, so if you don't really know what market risk is, that's okay. We're going to learn about it in this question, but let's go through the options to see what we have to choose from. Option A, taking out a short-term bank loan to meet cash flow needs. Option B, entering into a forward contract to lock in a foreign exchange rate. Option C, diversifying the portfolio across multiple industries and asset classes. Or option D, issuing fixed-rate debt to avoid interest rate fluctuations. So again, which one of these would best mitigate the market risk faced by a company with a large portfolio of publicly traded equity securities? Now, again, if you don't know what market risk is, or you don't really know how these strategies would help, that's okay. If you want to give this a try and give it a guess, then go ahead and pause the video. If not, let's go ahead and take a look at the explanation together. All right, here we are. The answer is C, diversifying the portfolio across multiple industries and asset classes. So this, out of these options, would be the best strategy in this case. So let's walk through this. Let's learn what market risk is. Market risk refers to the potential for losses due to changes in overall market conditions, such as economic downturns or volatility in stock prices. One of the most effective strategies to mitigate market risk is diversification, spreading investments across different industries, geographic regions, or asset types, such as stocks, bonds, and commodities. This reduces exposure to any single source of market volatility. And again, that makes sense because market risk is, again, the risk that something happening in the market that's external to the company will cause something to go down. Maybe something bad happens in the stock market, or maybe there's a recession, or whatever the case is. One of the best ways to make sure that they are not going to be as affected by that is by having their investments across multiple industries and multiple areas, because then if one area does bad, they still have multiple other ones that are maybe doing okay. Option A addresses liquidity risk, option B addressed currency risk, and option D addressed interest rate risk, which we will talk about all of those throughout the rest of the video. But again, this was one of the strategies you can do to mitigate market risk. Now let's go to the next question. All right, here we are at question 2, and with this question, I want to point out one of the strategies that we like to give to people, and that is to read the last sentence of the question first. This is a very good test day strategy because on the exam, you have no idea what you're going to be seeing. So reading that last sentence of the question first very frequently will give you context for what the rest of the question is about. It'll give you an idea what the question is trying to ask you. So let's go through this. Which option best mitigates the company's interest rate risk and why? Let's go up to the top. A company is planning to borrow $10 million to finance expansion. It has 2 loan options. Option A, a 5-year loan at a fixed rate of 6%. Option B, a 5-year loan at a variable rate starting at 5% adjusted annually based on market rates. Management believes interest rates are likely to rise over the next several years. So again, which option best mitigates the company's interest rate risk and why? So we have 2 options here. Basically a fixed rate loan or a variable rate loan that would be affected by the market rates. And they're expecting the interest rates to rise over the next several years. So which option would be best? Let's go through the answer options. And normally I say option A, but because we're also dealing with option A and B in this question, I'm going to say the letter instead. So letter A, option A, because locking in the rate protects against rising interest rates. Letter B, which is option B, because the initial lower rate saves interest cost in the first year. Letter C, option A, because variable rates carry prepayment penalties. Or letter D, option B, because variable rates are more flexible in changing market conditions. So it could be either A or B, but there are a couple different choices for whether it would be option A or B. Like, why would it be one of those in this situation? So based on what we read about this question, you might be able to think through this and figure this out. Pause the video if you want, and when you're ready, come back. We'll look at the answer together. Okay, here we are. The answer is letter A, and that would be option A because locking in the rate protects against rising interest rates. So the correct answer is option A because locking in the rate protects against rising interest rates, not because the variable rates carry prepayment penalties. Let's go through the explanation. Interest rate risk is the potential for increased costs due to rising interest rates. In this case, option A, a fixed rate, is the better choice because it locks in a known cost of borrowing and avoids exposure to future rate increases. While option B starts lower, it exposes the company to rising payments if rates go up, which is exactly what the company is trying to avoid. B and D focus on short-term or flexible benefits but fail to mitigate the actual risk. And then option C introduces an unrelated reason, prepayment penalties, which is not tied to interest rate risk mitigation. So again, this one's not too difficult to grasp. What you really want to be thinking about is if we know that interest rates are going to be rising or we expect them to be rising in the future, then wouldn't we want to lock in a fixed rate so that that rate stays and we don't have to deal with the higher rates in the future? So option B wouldn't have been as good because even though it starts out lower, if we're expecting interest rates to rise, it could very well eventually be higher than the fixed rate of 6% instead of, the variable rate of 5%. So this is one of the strategies for mitigating interest rates is to get a fixed rate instead of a variable rate. Now let's go to the next question. All right, here we are at question 3. Which of the following strategies would best help Raven Corp mitigate liquidity risk during the slower months? Okay, let's go to the top. Raven Corp is a seasonal business that generates most of its sales during the last quarter of the year. However, it must cover fixed expenses and payroll throughout the year. Which of the following strategies would best help them mitigate liquidity risk during the slower months? Let's go through the options. Option A, entering into interest rate swaps to stabilize debt payments. Option B, establishing a revolving line of credit with a commercial bank. Option C, converting variable rate debt to fixed rate debt. Or option D, investing excess cash in long-term illiquid securities. Okay, so again, this is trying to figure out how to mitigate liquidity risk for a company that has good months and slow months. So think about this, and when you're ready to come back, we'll look at the answer together. All right, here we are at the answer B, establishing a revolving line of credit with a commercial bank. This is one of the ways that you can mitigate liquidity risk. Liquidity risk is the risk of not being able to meet short-term cash obligations. Remember, something being liquid, such as cash or maybe even accounts receivable sometimes, that means that you can get money quickly to be able to pay off your debts quickly, like your current debts. If you don't have good liquidity, then that means you don't have enough money to pay off your current debts. But if you do have good liquidity, then you have enough money to pay off your current debts, the debts that are coming up in the next month or so. So again, liquidity risk is the risk of not being able to meet short-term cash obligations. A revolving line of credit provides access to cash when needed, especially helpful for companies with seasonal or uneven cash flows. It acts as a financial buffer to cover expenses during low revenue periods. So the reason it's revolving is sometimes they have that line of credit that they need to use, and then when they're good, they pay off the line of credit and they start making a lot of money in the seasons that they do make a lot of money. So that is one strategy for, again, addressing liquidity risk. A and C relate to interest rate risk, which we just barely talked about in question 2, not liquidity risk. And then option D would actually increase liquidity risk by tying up funds in assets that can't be easily accessed. So you wouldn't want to do option D, which is investing excess cash in long-term illiquid securities, because again, that ties up your cash in long-term things when what you really need is liquid short-term cash to be able to pay for things. So again, that's one strategy for liquidity risk. Now let's go to the next question. All right, here we are at question 4. If the spot rate in 90 days turns out to be $1.15 to euros, how much did Cobalt save by hedging and what risk did they mitigate? Okay, let's go through this. Cobalt Imports, a US-based company, is scheduled to pay 500,000 euros to a German supplier in 90 days. The current exchange rate is $1.10 per euro. Management is concerned that the euro will strengthen before payment is due. To mitigate currency risk, Cobalt enters into a forward contract to purchase 500,000 euros in 90 days at a fixed rate of $1.12 to euro. Again, if the spot rate in 90 days turns out to be $1.15 to the euro instead of 1.12, how much did Cobalt save by hedging and what risk did they mitigate? Okay, now I'm going to be totally honest. This question should be pretty easy because straight up, I already gave you one piece of the answer. So, because I said to mitigate currency risk, and then it's asking what kind of risk are we mitigating? So we know that it's currency risk. This is the kind of thing that you want to pay attention for in questions. This doesn't happen all the time, but there really is the occasional moment where if you carefully read the question, you are basically given the answer or straight up told what parts of the answer are incorrect if you pay attention. So again, this is something that you want to pay attention for on test day because there may be a few questions that if you're paying attention, you will easily be able to select the correct answer without even having to think too hard. Because again, like it says here, to mitigate currency risk, and then it's asking what risk are we mitigating? Currency risk. So we know that's the answer. So let's go through this to understand why or how we are getting to the $15,000 for this currency risk. So let's go through the answer. All right, here we are at the answer B, $15,000. And again, currency risk. We knew that B was probably the right answer, but let's learn how we got that $15,000. Let's learn how to do the forward contract and how this all affects the currency risk. Without the forward contract, Cobalt would have paid 500,000 euros multiplied by $1.15. That's $575,000 to get 500,000 euros. With the forward contract, they pay 500,000 euros times 1.12, giving you 560,000. So they pay $15,000 less by having this forward contract. So again, that's the savings. By using a forward contract, they locked in the exchange rate and avoided paying more due to a stronger euro, effectively mitigating currency risk. Basically, the idea here is they made a promise to purchase euros at a certain rate because they knew that they were going to have to pay 500,000 euros in 90 days, but they were expecting euros to get stronger. So they set a contract so that they would pay 1.12 instead of whatever the rate was going to be in 90 days. Now, if they had been wrong, then they would have lost money, but in this case, they were right. The euro did strengthen compared to the US dollar. So it saved them $15,000 because they locked in and said, hey, we will purchase 500,000 euros for $1.12 at $1.12 per euro in 90 days because they knew they were going to have to pay 500,000 euros in 90 days to that German company. So they made a better deal so that it cost them less to buy those 500,000 euros to be able to make that payment to the German company. So this is one way to mitigate currency risk, is to have a forward contract where, again, you lock in a currency rate so that in the future you can use that hopefully lower currency rate compared to the rate that there is when you have to do the purchase or whatever the case is. Now, option A was wrong because it's not a market risk, and we knew that. Option C was wrong because the amount is wrong and the risk type is wrong. And then option D mistakes the nature of the risk. It's not about cash availability, but about exchange rate fluctuations. Again, this is obviously a currency risk. We knew that, but this is how they could mitigate it by hedging with a forward contract to make sure that they paid less when they had to pay the 500,000 euros. Okay, so if that didn't make sense, make sure you take a second and understand how we calculated that difference for the forward contract. And when you're ready, come back, we'll go to the next question. All right, here we are at question 5. If the CFO wants to reduce the impact of adverse exchange rate movements while still accepting some variability in line with the company's risk appetite, which option is most appropriate? What type of risk will still remain? Let's go up to the top. Palmer Corp, a US-based company, expects to receive 2 million euros in 60 days from a European customer. The CFO is evaluating strategies to mitigate the currency risk, but notes that the company has a moderate risk appetite. They are willing to accept some volatility in exchange for lower costs. 3 options are under consideration. Option A, purchase a forward contract to sell 2 million euros at today's exchange rate. Option B, take no action and accept the risk of exchange rate changes. Option C, hedge only 50% of the exposure using a forward contract. So if they want to reduce the impact of adverse exchange rate movements while still accepting some variability in the line with the company's risk appetite, which option is most appropriate? Of course, you could probably argue for a couple of these, but again, which one is most appropriate based on what it's saying here? And then what type of risk will still remain? So let's think through these. A, which is option A, no risk remains. And then B, which is option B, inherent risk remains. C, which is option C, having residual risk remaining. And then D, which is also option C, where inherent risk is eliminated. Okay, so if you don't know what inherent risk or residual risk is, that's okay. That's kind of the point of this question, to talk about one more part of risks when it comes to this subject. Now, if you don't know what this is, that's okay. We're going to go ahead and look at the explanation together. But if you want to give it a try, pause the video, and when you're ready, come back. We'll look at the answer together. All right, here we are. The answer is C, which is option C, and because the residual risk remains. So that's the kind of risk that's still there after they do this. So because Palmer has a moderate risk appetite, a partial hedge, which was option C, strikes the right balance between protection and cost. So instead of doing option A, where they do a full forward contract, that could potentially have been good. But again, based on them having a moderate risk appetite and them wanting to only hedge a little bit, they hedge 50% with option C, and that makes more sense. Hedging 50% of the exposure reduces the potential loss while still leaving some exposure to possible gains or losses, which the company is willing to accept. The risk that remains after a mitigation strategy is applied is called residual risk. Inherent risk is the risk that exists before any strategy is applied. So that's just a couple small things that are easy to remember, and you very well might see them on the exam. Inherent risk is the risk that is there without anything happening. It's just the risk that is there when no action is taken. That's the inherent risk. It's inherently there. And then, as we've been learning throughout this video, you can mitigate risk through different strategies depending on the risk, but there will always be some risk left over, always. And that is called residual risk. So there's inherent risk, and then there's risk mitigation, which is what we've been learning about in this video. And then whatever risk is still left after you try to mitigate the inherent risk is called residual risk. So again, residual risk is the risk that's left over, and that's why option C makes sense, because they hedged only 50%, but there's still some risk remaining, so that's the residual risk that remains. And I just want to say it one more time, you can never eliminate 100% of risk. That pretty much never happens, especially in the CPA exam. If you ever see a question that says 100% of residual risk, or all residual risk is eliminated, or all inherent risk is eliminated, or whatever, most likely that is wrong, because it's pretty impossible to eliminate all risk. There's usually at least some kind of small risk no matter what you do. So we learned a little bit about inherent risk and residual risk, which go hand in hand with the risk mitigation strategies that we've been learning about in this video. Now, before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you about interest rate risk or about market rate risk or whatever the case is. Again, these are the things that you notice throughout the questions. And as you're going through them, you write these pillar topics out in your own words so that you know what is most important to know for the exam by, again, pulling out these pillar topics, these key points, and writing them in your own words. And as you do this each day, you are building your own personal repository of the most important things you need to know for the exam. So let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. First off, market risk can be mitigated by diversification. And I just want to say one thing. We didn't go over every single strategy that there is in this video. We went over a lot of the most important ones, and you'll probably learn a few more from doing your review course. So I just want to make sure that's clear, but we went over some of the big ones in this video. So again, market risk can be mitigated by diversification. Spreading investments across different industries, asset classes, or regions helps reduce exposure to overall market volatility. Now let's talk about interest rate. Interest rate risk is reduced by locking in fixed borrowing costs. Using fixed rate loans or interest rate swaps protects against rising interest rates by stabilizing interest expenses. And now let's talk about liquidity risk. Liquidity risk is mitigated by maintaining access to cash, and that makes sense. You want to have liquid assets. Establishing a revolving line of credit or improving working capital turnover helps ensure a company can meet short-term obligations. So again, we didn't talk about every single strategy that has to do with liquidity risk, but that's one of the ones, is having a revolving line of credit depending on the company's needs. Now let's talk about currency risk. Currency risk can be mitigated by hedging with forward contracts. You'll definitely see some stuff about forward contracts if you see anything about, currency exchange or things like that. Forward contracts lock in exchange rates for future transactions, protecting against adverse foreign currency movements. And then finally, this was a little bit different, but it definitely has a lot to do with risk mitigation. Residual risk remains after mitigation and must align with risk appetite. So again, there's inherent risk, there's risk mitigation through these strategies we've been talking about, and then there's residual risk. Even after applying a strategy, some risk usually remains, pretty much always. It's almost impossible to eliminate all risk. And the level of residual risk should reflect the company's willingness to tolerate volatility. So residual risk should not be greater than what the company is willing to accept when it comes to risk. It shouldn't be greater than their risk appetite. We didn't talk about that too much, but I just want to make sure that that's clear. So with that, we learned a lot about mitigation of risks through different strategies, and we have done everything we wanted to do in this YouTube version of the video. Remember, in today's video, we only went over 5 questions, but SuperFast CPA Pro members will get access to the full 10-question version of the video when we post it in the member forum. So if you like this and you like our other videos, make sure you check out becoming a SuperFast CPA Pro member so that you can get access to the full versions of these videos and a lot of other great stuff as well. And the easiest way to learn about and become a SuperFast CPA Pro member is by going to SuperfastCPA.com and signing up for our free 1-hour webinar training, where we will teach you in that 1 hour the key ingredients to passing the CPA exam. And after that, you'll want to learn more, and you'll, again, have a better path to learning about and becoming a SuperFast CPA Pro member. So check out the webinar, check out becoming a Pro member. Now, before you go, make sure to like the video if you liked it, or leave a comment in the YouTube video. I hope this video was helpful, and I will see you in the next one.